Let's have a look at the most talked about tweet when it comes to tariffs. This has been shared millions of times, been viewed by tens of millions of people, and there's some interesting points brought up. So let's have a look at it. Let's just read through this together. It'll take a couple of minutes, and I will post the link where you can find this tweet specifically. But let's have a little look. This is from Tanvi Ratna, and it's an interesting point on the tariffs in relation to the whole grand scheme. And I'm curious what your thoughts are on this. Trump's new tariffs aren't a trade tweak. They're a first move in a full spectrum reset. Talks about the $9.2 trillion worth of debt that matures this year, inflation, and so on. Let's dive right into it. $9.2 trillion must be refinanced in 2025 if rolled into 10-year bonds every 1 basis point. That is 1/100%. Drops in rates saves about $1 billion a year in interest that the U.S. is paying. So every 0.5% is actually about $50 billion, not $500 billion. There's some clarification at the bottom of the tweet about that. Lower yields free up fiscal room. Without them, core spending gets crowded out, right? So basically what that's meaning is we need to free up a little bit of cash in the interest rate side of things, what we're paying on U.S. debt. How to push yields down with a sticky inflation and a cautious Fed. Now, this is an interesting point, and we're going to show another chart in just a moment here. But manufacturing uncertainty sweeps in with tariffs, spooks the market, triggers a sell-off, money exits stocks, flows into long-term treasuries, and this kind of cools the economy, right? According to her. Now, if we look over here, we can have a little peek. Here's the 10-year yields. They were coming down pretty aggressively, pretty big run up today. Now, we're still in some kind of elevated 10-year yield territory here. But, it's off the highs a good little bit, but it's also off the lows a little bit. So it kind of seems a little concerning. The Chinese news today might have been a bit of a concern there. But with yields going up, that means bonds are headed back down, right? And so that's not what is hoped for in this outcome. When she posted this a day or two ago, 10-year yields were at 4.055. Right now they're about 4.16. So not super up there, but definitely up there a little bit. Cheap refinancing isn't enough on its own. Even at lower rates, the debt remains enormous. So this is where Doge comes in, cutting around $1 to $4 billion a day at spending. So trying to shave off kind of that $1 trillion in spending over the next couple of months. So that's kind of this. This is a good recap of kind of everything that's happening right now and how everything's going. With those savings, we've got Secretary Bezin's 333 plan, right, to get growth kind of restarted here. Tariffs come in as a trigger for domestic industrial revival. The thinking is by making imports expensive, you create U.S. producers' demand, right? Room for these guys to step in. But the problem is if factories can't scale quick enough, which they can't, of course, this can't be an immediate process, then short-term slowdowns, consumers will face higher prices. The administration knows this. That's why they're front-loading the pain now, betting that 2026 will the benefits will be visible. In the meantime, they're offering some near-term relief. Tax cuts have already been floated to help offset the cost and burdens on households. And while risky, currency devaluation may follow later to make imports cheaper without lifting tariffs. So hoping that there's going to be a tax rebalancing to kind of offset some increase in prices due to tariffs. Now, here's the interesting point here. Tariffs also bring revenue, and I think this is supposed to be $700 billion, not $700 million. Estimates suggest around $700 billion in the first year. Not a game changer on its own, but it gives the Treasury a bit more room to maneuver, especially if paired with deficit cuts. So there's our $700 billion number. Still, the approach isn't without risks, and this is certainly a risky situation, right? This whole thing could backfire, it could go terribly bad, but there are some interesting points to at least consider. If domestic supply chains can't catch up, or if global retaliation kicks in, inflation could rise. If inflation rises too much, the Fed is forced to raise interest rates. That is like the worst case scenario, and it's also very possible. A common critique is why impose tariffs without building out the capacity to replace imports first, right? But this assumes tariffs are the end goal, and they're not, according to the author here. They're the starting gun, a way to force both inside the U.S. and around the world, to force movement, to force discussions, to force all of this. Now, Trump has been a little bit all over the place saying tariffs are here to stay. We're able to negotiate about them, and so on. So It's been a little bit unclear there. On the geopolitics side of things, before tariffs, Trump's team signaled a global order reset, pulling back from NATO, cooling EU ties, opening diplomatic space with Russia and Saudi Arabia. So a lot of things are going on under the surface. We've been seeing all this, reading about all of it. Tariffs now serve as the leverage to renegotiate terms based on America First policy. Expect a lot of bilateral deals in the coming months. Tariffs will be lowered for countries that offer strategic concessions on trade, security, or industrial policy. Those that resist pay the higher costs until they decide to come to the table. China, obviously being the focal point here, observers have long argued China isn't a poor country, it's a wealthy, high-capacity state that floods the market with exports. Its currency artificially low. Tariffs could be used to force big moves like currency appreciation by China. Lines will be drawn with other allies too. Europe may be pushed to cut exposure to China or negotiate on Ukraine. India may be forced to cut tariffs and move closer to U.S. alignment. Mexico and Canada could face demand to crack down on fentanyl trafficking routes. In the U.S., there will be clear winners and losers. Steel, autos, textiles are likely to benefit industrials that form Trump's political base. But tech, retail, and construction sectors, more reliant to imports, could take a hit, especially in swing states. That's a political gamble. If jobs return fast enough in key states and inflation remains under control, the tariffs may look like a bold but effective move. If price spikes and job creation lags, the strategy could backfire by November 2026. Talks about Wisconsin seat loss. Less than 18 months to show results for midterms. Voters don't respond to stratagems, but respond to prices, jobs, and narratives. FDR had fireside chats. Reagan had Morning in America. Trump needs a similar consistent messaging to America. And that's probably what's missing a little bit right now, is just a consistent message of what's going on and why. So big picture, according to the author here, lower yields, ease the debt wall, spending cuts, restore fiscal discipline, tariffs jumpstart domestic growth, and geopolitics gets rewritten in America's favor if the disruption by design, it's disruption by design with enormous stakes. If it works, it's defining success. Debt under control, manufacturing reborn, global leverage restored, Trumpism vindicated in 2026. These are huge risks that are being taken here. If it fails, inflation, retaliation, lost midterm, strategic drift, and so on. 18 months to see how this plays out. Do you agree with these points with Doge, with China, with getting the world to the negotiating table, with bond yields? What do you think? It's going to be something we negotiate back and forth nonstop, but something will be interesting to discuss while we figure out and while we wait and see how things go. Dollar strength kicking in, bond yields up a little bit. We see that the stock market is recovering a bit. A lot of fear that there would be heavy selling on Monday, and so far we've got the S&P positive by about 1/3%, give or take. So it's going to be an interesting, obviously, couple of days, couple of weeks, and certainly several months to see how this plays out. I'm curious on your thoughts. I think these are some good points brought up. There's a lot of wheels in motion right now. And as long as those things keep on rolling, we should see some positives happen, but it's a risky bet. I'm curious about your thoughts. Leave a comment below. Thanks, everybody.